Good morning. I'm here with François from ARDIAN. François, perhaps you can start by introducing yourself and your firm.
Sure, my pleasure. So I am today a member of the executive committee of ARDIAN, general manager of ARDIAN France, and I am the head of the expansion team, which is basically the mid-market LBO expertise that we have within Europe.
Great, thank you. So my first question is, with interest rates edging lower, do you expect a revival of the deal landscape in 2025? What do you think will be the most popular deal structures? Will buy and build continue to be popular, or are you expecting other deal types instead of, or perhaps in addition to?
So maybe on the first part of the question on the deal landscape, I like to put things into perspective. So when I look at 2024, yes, there's been a rebound, but it's a small rebound compared to 2023, and historically speaking, on a long-term basis, it's still at a rather low level compared to previous years. Looking ahead, 2025, I would say I'm cautiously optimistic. Indeed, there's a little bit of pickup. I'm not sure that it is going to be to a great extent. Why? Because there is a bit of political uncertainty, there is macro uncertainty as well. And I believe that in this environment, what will prevail is quality companies that will still get a premium. So you still have that sense of market that is very polarized. Therefore, I believe that in terms of deal types, resilient and growing businesses, this magic combination will still be very much sought after by investors. So pick up, yes. Being super excited and enthusiastic, maybe less so.
Great, thank you. How do you see the environment for very large deals in general then, and consortium deals?
What do we need for general deals to happen? We need financing. Is it available? The answer is yes. No issue on that side. There is a lot of liquidity on the debt market. We need equity. Is there equity around? There is a lot of dry powder, so no issue on that side either. So I think the question relies more on the type of assets that will be offered to the market. There were some in 2024. I believe there will be also some in 2025, but that's really dependent on a few cases that will go or not onto the market. So I believe there is room. How many at the end of the day or at the end of the year will be done is more of a question mark.
And with so much money available, as you said, to be invested, will we see again the same actors lower their investment criteria for quality? Or will they accept higher valuations, also supported by record stock market levels?
This is not our mindset, for sure, at ARDIAN. But when I look at the market, prices clearly do not come down. And even for some assets, especially those who are resilient and highly growing, I would say that they even keep rising a little bit. My sense is that some players are indeed willing to maybe accept a bit of lower returns to the benefit of more comfort or more visibility. We think that we can still find on the ground many opportunities that offer both good visibility and good returns. And I think probably the topic is that it's going to be even more in the future about how you can help portfolio companies create value. So the kind of help that you can bring in terms of digital, AI is one of them for sure. Sustainability, these topics are not so new. Maybe the more recent ones are around pricing policy and HR, talent attraction, talent retention. So this is the kind of help and the kind of added value that the GP needs to bring to its portfolio.
Thank you very much. Moving on, European stock exchanges are having a hard time attracting new companies while losing existing ones to the US exchanges or take privates even. Do you think this will continue in 2025?
When I look at 2024, we were able to list a company. We had Planisware as part of our portfolio companies and went for listing, a very successful one, not just on D-Day, but on the evolution of the stock price afterwards. So there is availability on that front. Also on tech privates, we did that 4 years ago on a company called Artefact, active in data consulting and AI, very successful ones. So if the question is it feasible, the answer is yes. If the question is it going to be, especially when it comes to listing, the most favored exit route, I would be less sure. Why? I see two potential points of vigilance. The first one is that when you're largest shareholder, majority ones, you know that as a private equity fund, you will need to exit. So there is a sort of asymmetrical bet on the market because the market is expecting you with a rather short time frame to exit, so they are not rushing to buy, and that creates a sense of unbalance. That's the first point. The second one is around governance. Listing to be successful means that you have to educate your investors and keep them up to date on the way you operate the business, which means that the management of that company needs to spend part of its time, and actually when you look at historical evidence, it's a very substantial part of its time to discuss with their analysts and investors. So instead of focusing 100% of their efforts on operating their business, they have to take care of that part. Is it the best? Everyone can answer that question. We feel that we prefer management to focus on value creation and therefore on their companies.
So continuing on the companies themselves, how attractive are impact-driven businesses? And are they fairly valued at present? How do you see their future in general?
We believe in impact as a general trend, which is very important, and I would say twofold. First, we have launched a nature-based solution fund, which is growing very nicely, both in terms of fundraising and in terms of scope of investment. But we believe that this is only part of the segment. There is another one, which is how to help our portfolio companies to improve their carbon footprint, to be even greener, and basically to be even more impactful, I would say. We have invested a few years ago in a group specialized in packaging, and what we liked is that when we have invested, the management was very careful on that subject. At that time, only 10% of its business was on renewables, so impact stamped, you would say. Today, it's more than 40%, and I believe it's going to be closer to 2/3 in the future. So that journey to help them become, much more impactful, not just in words, but in terms of reality, I think this is a very good way to grow. And at the end, when it comes to valuation, which is the other part of your question, I think we will get a re-rating of the asset. So on pure impact funds, sometimes here and there, you may question the kind of valuation because there is a sort of unbalance between the demand and the supply of those assets. And we think a good way to broaden the subject is to actually make more traditional businesses much more impactful.
Great, thank you. And thank you very much for your time. I hope you have a lovely day at IPEM and enjoy the sunshine.